Our Colement case is on page 246. The next one we'd like to chat a bit about. This is a unique case because it is about a gambler who has losses and winnings, was a non-filer of tax returns, and so the IRS interceded and tried to determine both his taxable gains and his tax liability. And Mr. Coleman used a couple unique strategies here that were helpful to him in the process. So we'll learn some really good math on this one, Jerry.
Well, yeah, we sure will. And we've had lots of gambling cases over the years in rulings and cases, but I have never seen this particular set of, what happened during the case. So let's set out a few of the facts. Mr. Coleman, he was an insurance agent. He retires in 2004, had some consulting work. 2014 is the year of audit. He gambled a lot after he retired. And, we set out his income in 2014. He had some non-gambling income, the consulting, almost $77,000. Had a non-taxable personal injury settlement of $150,000 and had over $350,000 of gambling winnings from 160 W-2Gs. As Bob mentioned, the IRS did a substitute for return. So what the IRS did, as they will almost always do, they included the W-2Gs as income. They didn't add any other gambling winnings, but they had the 160 W-2Gs, didn't allow any expenses, and they assessed tax in the amount of almost $129,000. So let's look at the analysis, see what's so unusual about this. Well, the taxpayer testified, his wife testified, his adult daughter testified, nothing strange there. But another witness, their expert witness, was a gentleman, Mark Nicely, who is an expert in math, the casino industry, casino gaming equipment, particularly slot machines, where these W-2Gs, where Mr. Coleman had his gambling winnings. And he said, this is in the second paragraph here, he estimated the outcome of his gambling transactions using the win percentages of the various machines, and other, how often he gambled, things like that. He said, well, there were net losses of at least $150,000. Now, he's not going to get those. He's just going to get up to the amount of the winnings. So look at the next paragraph to see what's next. And think about this the next time you go to a casino. It would be virtually impossible for a player to have annual net gambling winnings because the return percentage from the slot machines between 87 and 95%. And in his opinion, the odds against Mr. Coleman having even $1 of net income were 140 million to 1.
So you're saying I have a chance, right, Jerry? There's a slight chance there. 140 million to 1. You're saying I have a chance.
Yeah. Good quote from the Dumb and Dumber movies there. So very well played there, Bob. So 140 million. Yeah, it's not very likely. So this is something, of course, in favor of the taxpayer. There's a few other items here too in the case. We tell you here, Mr. Coleman's other financial records. He's withdrawing money from ATMs, his credit card, his bank accounts on the casino premises, $240,000. He also had, he went through that entire $150,000 insurance settlement. His retirement account went from $75,000 down to about $2,700. He hadn't made any big purchases. So, he's not buying any fancy homes, fancy jewelry. His standard of living, his net worth has not increased, and it's pretty easy to see that his net worth has decreased throughout the year.
Yeah, so two critical components of this that resulted in an answer that was taxpayer favored is the fact of his really good expert witness who did all of the detailed review must have been very composed and very trustworthy on the stand too, but great mathematical support here. And then the other math piece that I saw was, well, his net worth really hadn't changed. There was no evidence of lavish winnings being added to his net worth. And I wonder, what will he do next year for his gambling issues?